Okay, and part of this, what we're talking about, let's just say that the marketplace rewards risk with return. And that's why, again, we're looking for this long-term result. And then meanwhile, though, in your risk management thing, as you said, you're taking advantage of the dissimilar price movements in order to smooth things out a little bit across the board and to reduce the overall risk. Yeah.
Good description, yes.
Okay.
So talking about the different types of real estate, we could talk about the different levels of risk of
getting into
real estate.
That, yes.
So the classic real estate is a single-family home in downtown San Jose, and mom and dad bought that property. Our clients call them mom and dad, and they've owned the home for 15 to 30 years. They've been receiving rent on it for 15 to 20 years, and because it's gone up so much in value, they now are fearful of selling that property because it's got high tax events if I were to sell it, and they don't know what else to do with it. So they hold on to it.
Yes.
And at the Family Wealth Consulting Group, we're here to help them understand why they should hold on to it, but if they do, here's the tax and economic consequences, and if they sell it, here's what we could expect from an alternative managed real estate portfolio. So let's talk a little bit about all the different kinds of managed real estate, from bare land to industrial property, to commercial property. Commercials are big tall buildings or shopping centers, or multifamily multifamily dwellings or apartment complexes. And I mentioned earlier the single family dwelling.
Yes.
As far as risk goes, I might have listed them almost in order of the risk, decreasing amount of risk. Bare land is always the highest risk in real estate because it has no income to cover the cost of holding it. And we want the city to move around bare land to grow out to my farmhouse and around my farmhouse, so that that farmhouse is now in the middle of town rather than the outside of town.
Right.
And at that point, that farmhouse land becomes quite valuable. But if the city doesn't grow that direction, it goes the other direction, that bare land is really high risk in anybody's portfolio at that point. The next highest risk, or the next level of risk down, might be a commercial building. The management of a commercial building is normally part of the highest risk of that investment. You want to make sure that you're buying the right address. As with all real estate investments, it's address, address, address. The next level of risk in your real estate portfolio might be multifamily or apartment complexes. Again, high management expenses, high management expertise is needed. You absolutely want to be in an area, in the right area of town and in the right town to own multifamily apartment complexes. Single-family dwellings are, for the most part, held by individual clients. Institutions don't normally buy single-family dwellings.
Well, there's a lot of banks that own a lot of them right now.
Except for right now. There's always an exception.
Okay.
So if my clients want to get into the safest real estate, it is always a completely diversified portfolio. So the way to get the biggest diversification in your portfolio is to own dozens or hundreds of addresses.
And maybe in different locations. So you could have one in San Jose, one in Texas, one in Florida.
Good. So real estate investment trusts, we acronym that REIT. Some people say RIT.
Okay.
A REIT owns normally dozens of addresses, many times hundreds of addresses. And as you spoke, Mike, it's diversified geographically. It may also hold a diversified asset class portfolio. So it'll hold multifamily, commercial, industrial, and maybe even bare land in various locations.
So let's see here. So let's talk about, you sort of got into this, is the differences between public and private real estate markets.
Oh, good. So what I mentioned was that when clients want to get into a conservative portfolio, we would define conservative as fully diversified. And a REIT is a way to do that. So if you buy and hold real estate long enough, if anybody buys and holds real estate long enough, they're going to get the average appreciation in the nation or in that geographical area for what real estate is producing. So they buy the property, hold it for 10, 15 years, and then sell it. And during that time frame, they get the same level of appreciation as their neighbor does. The profit from the date of sale to from the date of purchase to the date of sale is about the same as as any of his neighbors would have. Okay. A public REIT is normally a publicly listed company, so it has a prospectus to it. It has an accounting record such that a publicly listed accounting company would come in and make sure all those numbers are real, all the addresses are real. It normally is traded on a secondary market along with the stocks and bonds. So you get a security certificate from a publicly listed real estate investment trust, and you can buy and sell that on the secondary market daily.
So it's almost like it's a publicly traded stock where the company owns a diversified portfolio of real estate.
Good.
And then they,
Well
however, they have special tax rules that apply to them and so forth, about distributions and so forth.
Yeah, for a publicly listed REIT, they must pass through 90% of their income, so they collect rent from the tenants, and they must pass through, after expenses, 90% of what they've received.
Right.
Some of that is tax sheltered. Typically, a REIT passes through 6 to 8% dividend per year. That would be high in today's. We can find that in today's marketplace. It was high 3 years ago. So 3 years ago, we were getting 4 to 5% dividends, and about 20 to 30% of that is tax sheltered from depreciation.
Okay. So how does an investor know when to use public or private real estate?
Well, if a REIT is conservative because it owns dozens of addresses, a private placement in real estate may only own 1 or 2 or 5 addresses. Just by sheer definition, the public REIT is going to be much more conservative or safer for an investor than the private, but the private offers much higher potential.
As far as what sort of return you might expect.
As far as return goes. So let me start by saying that the private real estate program, you have to be an accredited investor, own $1 million of assets, or have a $200,000 income last year and this year. So not everyone is eligible for a private real estate investment. And the minimum investment into a private real estate program is normally $100,000 or more. So if you're going to invest in real estate, you get a choice between private, very conservative, public REIT is the best way to go. If you invest in a private placement of real estate, the upside potential is much, much, much higher. So it is common for me to be able to find private placements in real estate that have a track record of earning 20% returns per year.
And that's pretty exciting.
That's double what the stock market can produce, and sometimes 2 or 3 times what public real estate can produce.
Yeah. And of course, the stock market, we've just been through a period where nothing happened. So when we're talking about the stock market returns, we're talking about very long terms, where on some of the deals that you and I have talked about, we're talking more like time horizons of 5 to 7 years. And because we're talking really about management as anything else, as far as how they're in fact earning these returns.
Yeah, the efficiency of the marketplace is how I look for managers.